So good afternoon, technically afternoon. On behalf of the New York MBA, President Jeff Pinard, our entire board, and our Affordable Friday co-chairs, Brian Garris and Sherry Eccles, thank you for joining today's special webinar with our partner, Bill Teague from SONYMA. Before we get started, just a few quick housekeeping notes. If you experience any technical difficulties, please use the chat box and notify us. During today's webinar, all lines are muted except for our presenters, and there will be an opportunity to ask questions. Please use the chat box to ask questions. We'll do our best to address as many as we can during the Q&A session at the end. We'll be sharing the presentation slides and relevant resources with you after the webinar, so you can take notes also, obviously. We also urge all mortgage professionals to join the National MBA's Mortgage Action Alliance. It's easy, it's free. It's a way to stay informed on legislative issues that it can impact the way you do business. Just do a simple Google search for Mortgage Action Alliance. The National MBA's Mortgage Action Alliance is huge. So thank you for doing that. And without further ado, I'm happy to introduce today's presenter, is Bill Teague, as a Business Development Officer for the State of New York Mortgage Agency since August of 2014. In this role, Bill is involved with lender relationships, product development, lender training, and implementation to help mortgage lenders offer and deliver SONYMA homebuyer products, down payment assistance to low and moderate income homebuyers throughout New York State. And with that, I'll turn it over to you, Bill. I'm excited to hear what you have to say to us today.
All right, thanks, Brian. Excited to be here and sharing with you guys. So as Brian stated, I work for SONYMA, State of New York Mortgage Agency, right? Kind of, and we're this is the first slide, right? So SONYMA, right, offers first-time homebuyer loans, not exclusively first-time homebuyer loans. There are sometimes waivers on the first-time homebuyer requirement, specifically for veterans or for people purchasing in a target area. But they're designed to help low to moderate income home buyers overcome obstacles to getting into homeownership. We're going to feature and talk a lot about today about down payment assistance, right? Because it seems like a lot of folks have the income, but they don't necessarily have the money for the cash to close to get in, and that's where down payment assistance. And when I say down payment assistance at SONYMA, our down payment assistance can be used for both down payment and closing costs, and it can be mixed and matched with other grant programs or gifts and things like that. So let's advance to the next slide, please. So getting to know SONYMA, right, what you want to know about or what borrowers want to know about down payment assistance. Even before I worked for SONYMA, I used to get calls about that all the time, right, when I was in the mortgage business. Typically, and certainly on our what we call Achieving the Dream product, it's a below market interest rate. Right? I believe the rate on our Achieving the Dream product today is 6.375, which you guys can tell me if that's below market or not, but I believe it is.
Yeah,
so
that's real good.
We also have a home renovation program, right? A purchase rehab program, which we'll talk a little bit about, and a special veterans program. So New York State Mortgage Agency, right? It's a public authority created in 1970, so it's been around a long time. By the state government of New York to provide affordable homeownership opportunities to low and moderate income New Yorkers. So by low and moderate income, we mean we have every SONYMA loan has an income limit on it, right? The income limit varies based upon the loan program. There's basically two buckets for the income limit, what we call the low interest rate program limit, which is higher. It's about 100% of area median income. And then we have the Achieving the Dream program, which is a significantly lower interest rate, has a lower household income limit. Those limits will vary from county to county and also depending upon household size, right? We have one set of limits in each county for households of 1 and 2 persons, and then a higher income limit for households of 3+ persons. So again, they're targeted for first-time home buyers. Our definition, it's in here. So let's go to the next slide. I bet you it's right here. There we go. So what is SONYMA's definition of a first-time home buyer? It's a person who has not had an ownership interest in a primary/principal residence at any time during the 3-year period prior to the date of application for a SONYMA mortgage loan. And at the time of making the loan application and at time of closing, they don't own a vacation home or an investment property. So they may, and there's some subtleness to this, right? If you have a borrower who, let's say, was living in Ohio and owned a house there and transferred to New York 3.5 years ago, but they didn't sell that house in Ohio until last year. Even though they owned a home in the last 3 years, they did not occupy it as their primary residence, and they don't currently own a home, so they would be eligible as a first-time home buyer. So that's the rule. And kind of how we verify that, right, is we ask our lenders, we don't ask them, we require them to get 3 years of transcripts on all title holders. And that way we can see if there's anything on there that might indicate they did own a home in the last 3 years, right? Also, it will be backed up by information on the credit report. So that's part of, and this rule, right, it's not a SONYMA rule, right? It's IRS compliance. Because of how we fund the purchase of the loans from the participating lenders, which we're going to talk a little bit about, we have to meet IRS regulation on every loan file. We are what's called a state bond program. And because we use bonds to fund the loans, we have to meet IRS compliance on every file. So, right, SONYMA does not directly originate loans. They're offered through our participating lenders. We have, I'm going to say 70-ish participating lenders at this point. They're listed if consumers go to SONYMA.org, or mortgage bankers can go to SONYMA.org also. You guys aren't prohibited. That's our consumer-facing site, and that lists who the participating lenders are in each region of the state. It also lists our what we call our SONYMA Loan Officer Hall of Fame loan officers as well. Those are the people that have done the most SONYMA production and are most familiar with the product. So, and those lists are broken out by region as well. So you can make those lists if you become a SONYMA lender and are producing SONYMA loans. The whole point of SONYMA programs, right, is SONYMA programs often have a much lower overall cost and payment than FHA and other traditional first-time homebuyer programs. Primarily because A, we are subsidizing the interest rates, so they're below market quite often, and B, we use private mortgage insurance. We don't use the FHA, there's not an FHA mortgage insurance. There is an underlying insurance that goes on SONYMA loans called pool insurance, but the borrowers don't pay for that. We pay for that. It's embedded into the interest rate that we charge. Down payment assistance, right? So that's another advantage to SONYMA financing is every SONYMA loan, the borrower is eligible for down payment assistance. And we're going to talk about how that works. But the basic traditional SONYMA down payment assistance program offers the borrower 3% of the purchase price as down payment assistance up to a maximum of $15,000. And again, the SONYMA first mortgage, right, on single family, two families, condos can go to 97%. So effectively with the down payment assistance, which is the second lien sits in second lien position, your borrowers can get 100% financing on SONYMA loans. Again, lower interest rates because most of the time, I won't say always, but most of the time, certainly what we call the Achieving the Dream program, which is our lower rate program, is below market on interest rate. When borrowers choose to use down payment assistance with the programs, typically there's a 0.3% bump in the first mortgage when they use the down payment assistance loan. See, I jumped ahead, right? The DPAL is available with every SONYMA loan, can be used towards down payment or towards closing costs, or in some cases, it might even make sense for your borrower to use it to help pay single premium mortgage insurance to eliminate the mortgage insurance from the payment, right? It might help with ratios and help with qualifying. And there it is. I talked about this, but it's worth saying again, right? The basic DPAL, we have some specialty DPALs that are out right now. But DPAL, again, that stands for down payment assistance loan. We like acronyms in government, so there's a lot of acronyms every day. DPAL, it's $3,000 or 3% of the home price, whichever is higher. That used to be more relevant than it is today because we don't very often see home prices below $100,000, and it's up to a maximum of $15,000. And essentially, that gets funded by the lender at time of closing to the closing table. And then when we buy the mortgage from you guys as the lender, right, we reimburse upon purchase of the loan for both the first mortgage amount and for the DPAL that you guys advanced at closing. And then we also have right now a couple of specialty DPAL programs out there. One is called DPAL Plus. That is almost fully subscribed now. I think we put out 10 million, and so far we've used about 9.5 5 million. That offers borrowers up to 30,000 of down payment assistance to help bring their LTVs down and help them qualify more. That's only for that DPAL plus ATD. That's only for achieving the dream borrowers. We also have another program called Credit is Due that SONYMA has out. That also offers up to $30,000 of the down payment assistance loan. And that's a specialty program targeted at traditionally underserved communities. So basically minority borrowers, households of color can be eligible for higher DPALs within that program. But it does require that the participating lender, not all the participating lenders offer that program because they have to set up and maintain what's called a special purpose credit program, which not everybody has. So there's fewer lenders doing that, but you'll see and hear about it out in the field, obviously, because when you're throwing $30,000 out on a transaction of zero interest, zero payment money, it gets some buzz out there in the marketplace. So again, the DPAL, right? The SONYMA DPAL is actually a second mortgage on the property. It sits in second lien position. You close as a lender a second mortgage, but it's a zero interest, zero payment loan. And it's forgiven 1/120th per month. So at the end of 10 years, it would be completely forgiven. If your borrower or the homeowner pays off the SONYMA first mortgage prior to 10 years, we're going to look to recapture a pro rata portion of that down payment assistance. So if we gave the borrower $10,000 of down payment assistance and they sell the house in 5 years and they make a profit on the sale, we'd be looking to recapture half of that down payment assistance because it would have only amortized away half of that DPAL lien. All right. So SONYMA is designed to work really well with other grants and what we call grants and subsidy programs, right? Like for the bankers out there, right? There's the Home Buyer Dream Grant from the Federal Home Loan Bank. In every county in New York State, there's nonprofit housing counseling agencies that do pre-purchase counseling for borrowers, and also they're often conduits for grants from different agencies, right? Some of them are state agencies like the Affordable Housing Corporation. Like in Long Island, I think there's an employer funded grant program down there. So SONYMA works really, really well with those programs because we have no combined loan to value limit. So you can have the SONYMA first mortgage at 97% LTV in first lien position. You can have the SONYMA DPAL at 3% or maybe even higher in the second lien position, taking you to 100% CLTV. And you can have some other types of grants and subsidies, which typically file liens as well, right? So they're sitting in third lien position so that your CLTV is unlimited at SONYMA. So again, Affordable Housing Corporation, which is kind of a part of the same agency SONYMA is part of, that's a New York State agency. They offer typically in different scenarios up to $20,000 to $40,000, and I don't know the exact qualifying on them because I'm, I guess, not ambitious enough to inquire with them. But they're out there. We see those quite often. HUD block grants that are sometimes available through municipalities, the employer grants on Long Island, local municipal grants, and like I said earlier, the Home Buyer Dream grants, which the Federal Home Loan Bank lenders participate in. So SONYMA works really well with them. So here's a sample SONYMA transaction, right? And purchase price $200,000, closing costs and escrows total $12,000. So the total cost to get into the home for the buyer, $212,000. They could get a SONYMA first mortgage at 97 LTV, which would be now $194,000. SONYMA DPAL, the standard DPAL 3%, which would be $6,000. We will allow on 97 LTV sellers to pay up to 3%. And for LTVs of 90 or lower, they can pay up to 6% toward borrower's closing costs. Borrower has a minimum contribution on SONYMA loans. They have to come in with 1% of their own funds, 1% of the purchase price. So this borrower minimum contribution you see on there of $2,000 is the $2,000 borrower's minimum contribution. And then they could also get grant funds, gift funds, or their own funds for that other $4,000. So that's kind of how we're piecing together transactions to get people over the cash to close hurdle on SONYMA transactions. Home buyer education. We're big believers in home buyer education. There's multiple courses out there. Any HUD approved course is acceptable for SONYMA loans. I know Fannie Mae has one. I know Enact, the mortgage insurance company, has one. I'm sure the other MI companies have them. There's eHome America and all the local in every county, right? As I mentioned before, there's local nonprofit housing counseling agencies that also offer pre-purchase home buyer education. Most of the time, there's certain, like if borrowers are putting 20% of their own funds down, we may not require home buyer education. But for almost all Sonny Mae loans, the borrower has to take pre-purchase home buyer education. They get a certificate saying they've completed that education. They give it to their lender, and then we know they've done the pre-purchase home buyer education. But there's data that indicates that the default rates on borrowers that have had pre-purchase home buyer education is much lower. So that's why. Because, right, all of us who live in New York State, we're the owners of these loans, right? The state is putting the money out there, but the default ratio is very low on Sonny Mae loans. So, and the mortgage and the pool insurance helps as well. So I don't think we're in jeopardy as citizens of the Sonny Mae portfolio. So, how do borrowers apply? Right, we get calls all the time into our what we call our hub phone. And we try to refer the borrowers back out to participating lenders because they have to apply through a participating lender. You can't apply directly with Sonny Mae for a Sonny Mae mortgage. So if you are not a participating lender and would like to become one, you can reach out to me or Sonny Mae has 2 business development officers, right? I'm one, and I cover basically Westchester, Rockland County North, and the rest of the geography of the state. And then in New York City and Long Island, we have Delphia Munoz. Delphia's awesome, and she covers those territories down there. So if you are interested in finding out about becoming a Sonny Mae lender, you can reach out to Delphia or myself. So how do we qualify borrowers? So this is kind of the credit criteria, right? And I guess I should bring this up now since I'm thinking of it, right? When you're doing a Sonny Mae loan, there's both, they have to credit qualify, which is what you guys are always used to doing, right? Do they have enough money for down payment, closing costs? Is their credit acceptable? Do they have stable income that we can generate a good debt to income ratio off of, et cetera? There's also the eligibility piece, right? The eligibility piece is some of the things we've already talked about. First-time home buyer status, right? They have to be a first-time home buyer unless they're a veteran or purchasing a target area, and under the household income limit. So that's eligibility. But this screen here is talking about credit qualifying. So we want to see 2 years stable employment / income, right? A 12-month credit history. We have a credit depth requirement. We want to see at least one borrower on the transaction has 3 trade lines that have been open for at least 12 months and active in the past 24 months. Now, we accept alternative trade lines, right? So if a borrower doesn't have 3 trade lines on their credit report, they can qualify by getting 12 months proof of rent payment history, right, through an acceptable way. 12 months payments on their cell phone, 12 months payments on their utilities, their gas, electric, whatever. So you can build alternative trade lines to qualify for a manual underwrite for Sonny Mae loans. So we do actually occasionally close loans for borrowers who have no credit history, right? They have no credit history, no FICO score, but they can build manual trade lines with us and take advantage of a manual underwrite. And again, they have to have either 1% or 3% of the purchase price in the bank at the time of application. So they do have to have that borrower's minimum contribution. The 1% I mentioned earlier, right? That's on single family, 2 families, and condos. The 3% is for you New York City folks, cooperatives, and 3 and 4 family homes also require at least 3% of the borrower's own funds to go into the transaction. Homes that qualify. So single family, 2 family homes, 3% down. Condos, 3% down. For condominiums, we don't maintain an approved list of condos. We ask for a questionnaire each time. So if you have a borrower that's purchasing a condo and they're going to use Sonny Mae financing, we would ask you to early in the process get a condo questionnaire completed. I can send you the form that we all have. Get it back to us, and we'll review the questionnaire. And usually, typically, it happens really quickly. Our underwriter that does this stuff is really quick on the spot approvals. So usually within 24 hours, yes, we are good to finance a unit in that project. Cooperatives, up to a max of 95 LTV is the Sonny Mae loan max. Depending upon the cooperative where they're buying, they might not allow 95 LTV. So cooperatives are 5% down, right? 95% LTV max with 3% borrower's contribution. And again, on cooperatives, same thing. We have a short list of what we call project set-asides. That's for new construction co-ops. But for existing co-ops, we want to get a co-op questionnaire completed. We might ask for 2 years of financials. You email it to myself or Delphia, and then we have the underwriters look at it, and they come back and email us what we call spot approval, where they're saying, yep, we'll entertain an application on a loan in this project. We do a lot of co-ops. So 3 and 4 family homes, minimum of 10% down. We also on 3 and 4 family homes don't have that that FHA rule, right, where the rents on the other units have to cover the mortgage payment. We're just going to use one debt to income ratio, keep it simple. We also do double wide manufactured on land with a foundation or footings and piers below the frost line. We would treat that like a single family. We'll go to 97 LTV on those. So fixer upper. A lot of first-time homebuyers are out there looking at properties and they're getting outbid by maybe cash buyers or other people on the pretty homes. So they might want to consider a fixer upper, right? So yes, SONYMA offers a Remodel New York program, and that is our version of Fannie Mae home style or FHA 203K, right? So it allows financing of the purchase price of the home plus the repairs to be done, and that should say done after purchase. I missed that when I was reviewing this. One loan to buy the home and pay for repairs and improvements. We do training on an ongoing basis on the program. The participating lenders, now we don't, at this point, new participating lenders can't originate the Remodel New York loan until they've sold us 25 loans, and then we'll do all the training on that. Best to get familiar with the regular program and the IRS compliance first, and then take on, because those are more complicated transactions. Any of you out there who've ever done purchase rehab loans know you have to get a lot more data in prior to underwriting the loan, right? You got to know what the repairs are going to be, who's going to do the repairs. Most of the time there's a HUD 203K consultant involved, even though we are not an FHA loan. For most of our purchase rehab loans, we do have a HUD 203K consultant involved. But as part of that, right, if we have, for our achieving the dream eligible borrowers, which is that 80% area median income level, we also offer a repair escrow subsidy of up to $20,000 for eligible borrowers. Basically, that's $20,000 of money that technically happens similar to how the DPAL is, right? It sits as a second lien, zero interest, zero payment on the loan. We put it into the repair escrow at time of closing, and that's to cover necessary items to bring the home up to code, and or handicap accessibility, and or just anything that might be a hazard within the property. So bring it up to code, health and safety, and anything to make the house more energy efficient and or handicap accessible. So again, that's zero. That's kind of like DPAL money, right? It's zero interest, zero payment money that we'll throw into the repair escrow, and it self-amortizes away as forgiven over 10 years. So here's a sample transaction on a SONYMA Remodel New York. So now with SONYMA, right, one of the differences between ours and the FHA 203K is we're still limited to, on the SONYMA first mortgage, 97% LTV based upon the after improved value. I'm pretty sure with FHA, you can go to like 110% of after improved value when you do their 203K. So we're a little more limited, right? We can only go to 97. But here's a kind of a breakdown of a simple transaction. Home purchase price of $200,000. Total repair escrow, right? That's all the items that go into the repair escrow. The money to pay the contractor for the scheduled work, the contingency reserve, the permit fees, the consultant fees, a title bring down for the last draw. So let's say that total repair escrow totals $50,000. So your borrower has kind of a total acquisition cost of $250,000. Closing costs and escrows are $14,000. So total costs to get into this house and do this project, $264,000. On the right-hand side of the screen, right, you'd be able to get a SONYMA first mortgage in this transaction for $242,500. The DPAL would be based upon the $250,000 total acquisition cost, so they could get $7,500 there. The seller would be allowed to pay up to 3% toward closing costs and prepaids. Borrower's minimum contribution would be $2,500, and then either some other grant, gift funds, or something else that could cover that other $4,000. So there we've covered and pieced together again the total of $264,000 that's needed to get into this house and do the after closing repairs that are going to be done on the property. Some other things, right? SONYMA does allow non-occupant co-borrowers. So I talked about that credit depth requirement, right? The 3 trade lines. If borrowers can't meet the credit depth requirement, even with alternative trade lines, sometimes they can get either a non-occupant co-borrower or a guarantor to meet the credit depth requirement for them, right? These are folks who will sign the note. They will not occupy the property. They will not go on title, but basically they're co-signing the note for the borrower. So again, non-occupant co-borrowers can also be used to help with debt to income ratio, because we're relatively strict, I think, compared to the agencies and FHA when it comes to debt to income ratios, right? We have a max housing ratio of 40%, max total DTI of 45%. And sometimes our underwriters will make exceptions to that, but we won't go as high typically as you know, an FHA loan will go, or sometimes even a Fannie Freddie loan. But you can use the qualifying of a non-occupant co-borrower to help with debt ratio. Right? We're still going to require that the occupant borrower or borrowers be at a max of 50% total DTI. Right? So these guarantors and or non-occupant co-borrowers, they don't go on title. And there's a reason they don't go on title. If they go on title, we'd have to count their income toward the household income limit. We don't want to do that. So they're going to sign the note only. And then by not being on title and not occupying the property, they don't count toward the household income limit. And there's no restriction on relationship, right? Anybody you can get to co-sign that loan for you is fair game from our perspective. So these are contact, right? If you are in New York City, Long Island, and you have interest in Sonny Mae, or you do work with a Sonny Mae participating lender, and you have questions, you need training, you want to request something, you need clarification on something, right? You would primarily reach out to Delphia. That's her contact information. If you are anywhere else in New York State other than New York City or Long Island, you would reach out to myself. And we're like the bridges, I like to say, right? Because Sonny Mae is a government agency. Delphia and I both worked in the private sector. We know what you guys are doing out there. So we're kind of bridging. Sometimes it's a language barrier and sometimes it's a culture barrier, right? Between the government sector and the private sector, which is what you guys are. So we're pretty empathetic to what you guys are going through out there, right? The frying pan you live in as retail mortgage loan originators. So we can help you guys with problem solving, with ideas, with things like that, with understanding, or with sometimes getting exceptions, things like that. So we are the primary points of contact for the lenders with Sonny Mae. And I think that's all I have. Do we? I don't see the chat box right now, Brian. But is there any questions?
I don't see any questions. If you have anything in your mind you want to ask Bill about, well, we have the webinar open. Please use the chat. I have a question for you, Bill. I was just thinking about the down payment assistance, the DPAL, the specialty DPAL, and all this. You made a comment about the funds being fully allocated or almost fully allocated on that. How does that work? You know, the Affordable Housing Partnership has a home buyer fair coming up.
Yes, they do.
When you talk to you know, direct to consumer, you're having those conversations with the prospective borrowers on these programs. What do we need to know about the allocation of down payment assistance funds?
So the one that I was specifically talking about is called DPAL plus ATD, which is an acronym for Achieving the Dream. So that's for borrowers who are at our Achieving the Dream household income limit and are first-time home buyers. They can get up to $30,000 of down payment assistance loan money to help them qualify, right? So it can be used to pay the LTV down as low as 80%. But when we announce these programs coming out, they're not like our regular DPAL, that 3% up to 15,000. That's continuously funded, and that pool of funds is replenished because when you use the regular DPAL, right, there's that bump in interest rate, and that replenishes that fund. These specialty ones, the DPAL plus ATD, that is where the first one we ever did, I think there was a settlement with a bank that the attorney general had, and they said, what are we going to do with this, whatever the number was, $50 million that was just paid in the settlement? And they took and they put $5 or $10 million of it toward a program like this. So it's really about, is the funding available? And we have not, so for most of that, we have not been able to, and I don't know, we don't have a new budget yet from the state for this year, but I expect they'll have one soon. So there might be more money allocated to that going forward. But when we announce it, we say, hey, so we did on the DPAL Plus, we did two. We did one back in the fall for $5 million, and when that was fully subscribed. Then later in the year, I think closer to the end of the year, it might have even been in January, we were able to get another $5 million. So it's really about, is the funding available to us to put towards that?
Got
Now,
it.
there's another one, what that credit is due program, and that the goal on that is to have it continuously funded. And that is, again, is a program targeted at households of color, and also certain national origins. I saw another
Gotcha.
question, I think, pop up in the
Yeah, let's pop that open here.
picture of me, says Joe
This is
Culver.
Hope,
Look at that.
Hope S. Yeah, you're Joe today.
Joe
Hope
just got
S.
a lot better looking.
Can we have a copy of the slides used for this presentation? Yes, Hope. We will send that out with your registration for the webinar. We have your contact email, and we'll send that out to the folks that attended today. Absolutely. All right, so Bill, that's interesting. So it's really the credit is due program. That's the one that so I mean, I guess how would lenders keep track of the availability of funds in that situation?
Right now we are running banners across our AUS system, SONYMA Express, to notify, but
Okay.
they also email me. I get reports a couple times a week, so they email me as well to find out. So the one, right, the DPAL Plus Achieving the Dream, the ATD, that is there's under $1 million left in that. Last I looked, I think it was like 600,000. So depending upon activity over the next 2 to 3 weeks, that might be exhausted soon. But the credit is due pool is expected to be continuously funded. Again, it's a more limited pool of borrowers and lenders.
Gotcha. And what's the trigger for there's, I'm sure, every loan that is submitted with this down payment assistance, there's got to be some what's the catalyst that creates that line
The
item on the
eligibility for
budget
it?
that says the funds are spoken for? Is it an application submitted for underwriting, or what's the
So when
registered in the system?
so when they upload their loans to our AU system, right? SONYMA does not. You don't use DU or LP for SONYMA. You use what's called SONYMA Express, and it's our proprietary AU system. When they rate lock the loan, if they've got a borrower that meets the criteria and there's still funds available for that additional, the traditional DPAL is 3% up to 15,000 is always available. Yep. For those other specialty ones, if there's funds available, when they reserve and rate lock the loan with us, those funds get allocated to that loan. Gotcha. Right? They're reserved for that loan. So as long as you close that loan, the funds will be there. So what'll happen is, we know we kind of know what the fallout rate is. We know what amount has been reserved, and we have a couple people that track it, and they inform me and Delphia, and then folks reach out to me for that. But like I said, there is a banner running across our AU system that's letting them know that as well, that the funds could be running out soon. And that's awkward, right? Because you got people out there looking for homes, counting on this money to qualify, and it's hard to find homes right now, right? So it's a little bit of an awkward situation for you guys, because they're counting on this. And what you don't want to do is put pressure on people to buy a home that's not really right for them just to get the $30,000.
Right.
So we understand that. We don't have a fix for that, right? So that creates little distortions, I think, in the marketplace.
Yeah. Excellent. I mean, your presentation really, to me, it reinforces the need to be involved with the nonprofit housing agencies also, from a awareness perspective of the tools that you could deploy in a transaction, grant funds, other assistance that's out there in combination with SONYMA. I think if you're not actively working with your local nonprofit housing association, I think that's probably a great first step if you're looking to get into this space.
And a great way to find them is they have an organization called HomeSmart NY. If you Google HomeSmart NY, and I think if you misspell it, you get some weird agency, but if you Google HomeSmart NY, that's like their statewide association. And you can plug in what county you live in, and it will tell you who the agency is in your county. There's also, I think, a link to that on the SONYMA consumer website as well.
Excellent. We have a message from, oh gosh, Elosa. I'm sorry about your name. I'm going to mess it up. But she says, super. You just helped me figure out my current New York remodel loan. Thank you. So if we can just have one person, Bill.
Remodel loans are never fully figured out until they close and get funded.
Yeah.
But yeah, so yeah, reach out if you want questions on that. We're pretty fortunate to have that program. It was a big deal when we implemented it, and so I like to, and I do training on it every month through. We have what's called SONYMA University, and we publish the training calendar every month for folks to sign up and come and get training on things just like that. That's a 2-part training, right? We have to, because purchase rehab loans are complicated, a lot of moving parts.
Absolutely. One of the other things I thought was a little complicated, not complicated, but it's some nuance with it, is the non-occupant co-borrower is essentially related to conventional lending, like a co-signer. But they're not on title. You're looking at their income as a compensating factor, but you're not using the income when you look at the 50% DTI qualification by the primary occupant.
So right, we're gonna work up a debt to income ratio for them, including the non-occupant co-borrower.
Mhm.
But we're also going to run a ratio on just the occupant borrowers, and they still have to be under 50% DTI. It primarily gets used for the credit depth requirement, right? And that can be a guarantor also. And then within credit is due, which is that's one of those specialty DPAL programs. You can actually there's even higher tolerances for DTIs with non-occupant co-borrowers within that as well.
Gotcha.
I didn't want to go too deep into the weeds on everything because we have limited time, and I could talk about this all day.
No, that makes sense. That makes sense. But we, as the practitioners of this business, the boots on the ground, we do get these questions all the time. And one of those things is, well, your debt to income ratio doesn't fit the program. The next thing that comes up is can we find another? Is there another family? Does it have to be a family member, by the way?
No.
That co-signer?
No.
No. Okay. Another
borrower
on the application.
We made that decision too, but yeah, like I said, anybody with good credit and who's willing to co-sign that loan is who they can get as a non-occupant co-borrower.
Okay. So along those same lines of qualification, if you have a 2-unit property, how do you handle the rent on the second unit as far as
We
income?
would treat it in qualifying just like you would on a conventional loan or an FHA loan.
Okay.
So you would take 75% of the market rent, add it to the borrower's gross monthly income, and then run your ratios.
Does that affect their AGI?
It does not count toward. It doesn't count toward the household income limit.
Okay.
So the rent from the subject property wouldn't count toward the household income limit, but you can use it in qualifying. So you kind of get, this is the 2 answers you want on that question.
We don't want to those are the 2 answers that you want on that question. That's good. That's
we don't want to push them over the household income limit, but we do want to be able to use it to qualify.
Okay. Excellent. Excellent. Any other questions? I'm dominating the question space here, guys. I apologize. Sherry, anything that comes to mind? Joe?
No, this is terrific.
It is awesome.
Agreed.
Yeah,
awesome.
No, I love the interaction here at the end as well, which, is certainly helpful. Bill, thank you very much. But Brian, we'll turn it back over to you to just continue and wrap it up here and thank our wonderful presenter.
Excellent.
Hey, thank you, everybody.
I do have one more question for you, Bill. One more question. Right? We're going to cut it early, I think, based on the awesome content and efficiency we got through. But so if you have with that credit is due program, that's the special purpose credit program for minority borrowers, right?
Right.
So if you're a non-minority borrower, and that 30,000 would benefit you, obviously, to get you out. Can you find a minority borrower to co-sign for you? Is that appropriate?
No, it's based upon the race and ethnicity of the primary borrower.
The primary borrower. Okay. Right. I'm glad I asked that one.
Yeah. So basically, any race or ethnicity is acceptable except for non-Hispanic white.
Okay. Gotcha.
We did get one question in terms of sharing the slides. So Joe will share the slides after the presentation with the attendees.
Yes, and then we also post this out in a couple of days. It'll be available out on our YouTube channel. So everybody can go in and watch it as well there at any time in the future, should they accidentally delete it in their email for some reason.
Brian, Jim Bob said you should have been a litigation attorney with a specialty in cross-examinations.
Well, thanks, Jim. Appreciate that. I think maybe. All right, folks. Well, this is awesome. Sherry, I'll let you, if you want to wrap it up for us, that'd be great. Any other questions? I don't think we've got anything, so rock and roll.
Yeah, so thank you, Bill, so much for coming on. I think you might have gotten the highest participation that we've had in quite a while on a session.
Yes.
So
Yeah, 100%.
super happy that you were willing and able to join us. Great information. And for everybody else, we've got some great speakers coming up. Mark your calendars for the third Friday of every month. And at 12 o'clock, we'll be here to present you with more good information. I also would just take 1 second to urge you to contact your local representatives about good cause eviction and let them know that there are provisions in that would be detrimental to the development of housing. It's in the budget. It's sounding pretty signed and sealed, but anything we can do at this point to try to mitigate it, as they're still kind of hammering out those final details, would be critically important. Any little gain is going to have an impact. So I definitely urge you to do that.